to Imperial Investment Insight Podcast. I'm Jamillah Thabet.
And my name is Sanjay Lodha. Today we are delighted to welcome Miguel Fidalgo, Founder and Chief Investment Officer of Triarii Capital.
Hi guys.
Hello. Starting his career at Citibank, Miguel entered the hedge fund industry, working at Baupost during the financial crisis. He later founded Triarii Capital and Project X, and he's also an investor in XII. We're very excited to have Miguel on and hope you enjoy our conversation about investing and innovation. Miguel, welcome to the show.
Thank you.
So we saw you study economics at Macalester College. Were you always interested in finance? And how did you make the decision to go into finance industry?
Sure. So I studied in the American system, and as you might know, the American system has these things called majors and minors.
Yeah.
Mm-hmm.
So you can get a degree, and depending on where you go to school exactly, call it half your actual coursework might be in what your degree is in. You can also have multiple majors, multiple minors. So I ended up having a double major in economics and computer science, and doing a music minor.
Nice.
I ended up doing finance very much not on purpose. So I first year of university, so freshman year of college in American terms, I declared a double major in computer science and music, no economics. I had not taken economics in high school. I had taken social anthropology. Then second year of university, I took a class, the equivalent of Econ 101. And the whole idea at the time was I wanted to know how to balance a checkbook and do I wasn't thinking in terms of it as a career. But I found the subject matter really interesting. And for any econ nerds in the crowd, the class that really sold me on it was the second class of that module, where the professor taught the concept of opportunity cost, which at the time, and perhaps to this day, was one of the more practical things I've ever learned in a classroom. It's a concept, right? It's the idea that the £5 that a cup of coffee might cost me is not just the £5 for the cup of coffee. It's also what else I could have done with those £5, the time that I spent drinking it, and so on and so forth. And obviously, it generalizes the time that you're spending here today recording this podcast. You could have been studying, you could have been partying, you could have been doing all sorts of other things. So it's sort of a very basic principle that applies to decision making. I thought it was really interesting, and so I decided to take another class in economics and another class in economics. And by the time I was done, economics had become a double major with computer science, and music I made a minor out of it. And that was really it. And then in parallel, so this is what happened was in the American system, it is quite common for people to do internships. So both in the summer, but also sometimes during the school year. And I've always been interested in the applied world. So while in university, I basically got internships at a couple of hedge funds. Now, it's important because to note the context, not unlike what's going on right now with NVIDIA and Bitcoin and those types of things. At the time, which would have been the late 90s, the sexy thing was all the tech stocks like Yahoo and whatnot. So there's very much an interesting parallel. Well, I was a second and third year student at university. I was day trading stocks out of, I had some, suretrade.com brokerage account, and I found some hedge fund that got me a phone. And it's like a feature phone, the ones where a number had 3 letters to type, multiple generations ago. And I got trading permission from this hedge fund. So I was literally sitting in class trading stocks for a hedge fund, which is not something I would recommend you do. But so I got really interested in the applied investing world. And then that hedge fund, which is, as you might guess, a smaller hedge fund, then I got another internship at a more of a Wall Street type proper hedge fund that did emerging markets investing, credit investing, and so on. So it sort of broadened my horizons. And after those two and getting the degree in economics, I finally went to New York and I wanted to do the Wall Street thing. So it was a bit of a slightly accidental, slightly making incremental decisions that made sense at the time process that got me to this as a career.
And what about your music journey?
I play music every day.
Oh.
I play music every day. I will occasionally perform for others, but certainly at a minimum for myself, I play it every day. And it ended up being a big part of my life still.
Like any specific instrument?
I play guitar, and
Nice.
if you play guitar, the way I like to describe it is if it has strings on it and frets, I can probably figure something out. So over the years, I like to think it at a reasonable pace, not too fast. I've added a few other string instruments. I own a banjo. There's something called a Portuguese guitar, and I own a few other things.
Yeah.
But that whole family of string instruments.
That's great.
That sounds amazing.
Yeah.
A bit of topic, but you experienced the 2008 financial crisis
Yes.
firsthand as an investor.
Mm-hmm.
Could you tell us what it was like back then and Was it a formative kind of experience in your journey?
Yes and no. I would say yes and no, because so if you think of it as something that's pursuing a profession, the problem with the 2008 financial crisis is that at best you'll see something like that twice in your career. Chances are what you will see will never be exactly the same. And so it's the best way to benefit from a financial crisis like that is to be in a position where you or your firm does not blow up, and you can then, on the other side of the big stress, benefit disproportionately from the recovery. Right? That's sort of the sweet spot where you're either haven't started yet, or you just started, or you're at the right place, right time. And when stuff happens, you're okay, and you're on the front foot. You're sort of able to then take advantage of the dislocations. It's, in a way, bad training for pursuing this as a profession, because you only get that every once in a few years. And you can attempt to have a career on the basis of you only invest when you have the global financial crisis or something similar to it, but it's really, really hard. Most of us have to find something to do anywhere from every few years at the most conservative to every day if you're at a very sort of trading-oriented type of institution. So that's a consideration. What the global financial crisis does help one with is this idea of making you realize how fragile everything is. And so we take for granted that HSBC is a bank, and HSBC is going to be a bank tomorrow and the day after. Or we take it for granted that rule of law in the City of London will continue to exist, and so on and so forth. And it's surprising how or how fragile, or how not necessarily written in stone all that is, right? A bit of an aside, but at one point I took some training with, this is a very American thing, but like survivalists, people that go out in the woods and sort of, survive in the woods and that type of thing. So one of them, one of these teachers I had a quote where he said, civilization is always 9 meals away from anarchy. The idea is if you have a natural weather disaster, like a hurricane or whatnot, or a man-made dislocation, some sort of a very significant terrorist attack that sort of disrupts a city like London for multiple days, after about 3 days where people can't get food and water, a lot of the civility and the rule of law starts at a minimum being stressed, possibly breaking down. And you see that in financial markets, and something like the global financial crisis gives you that, where at one point in time we're sitting around and it's like, okay, well, Lehman Brothers just went under, and Wachovia rather is going next. It's also Morgan Stanley going next, and once you have those, then all bets are off, right? And so it kind of helps you think through when you're the 20-something that goes to your boss and says, I have this very interesting investment idea, and if the price of this goes back to what it was last year, or if Bitcoin goes back to where it was, or if gold is this thing, we're going to double our money, and this boss person says, well, what if it doesn't? Or what if it gets even worse? And you're like, there's just no way. It's gold. There's just no way. It's HSBC. Mm-hmm. You sort of start realizing that, yes, there is a way. And to think, in a sense, creatively and out of the box, like stuff that doesn't happen, that isn't supposed to happen, quote, doesn't happen, actually can happen and does happen, is it's very good training for a lot of forms of investing.
Yeah, perfect. And we can see that there have been many notable value investors in the past, including but not limited to Benjamin Graham, Warren Buffett, and Seth Klarman, the latter which you have worked for, just to name a few. What makes them such a great investor, and what can we learn from them?
So of those, there's only one I've met personally, but I've certainly read about the others. So the whole value investing framework is at a very general level to ascribe a value to something, an intrinsic value that's sort of not a matter of opinion, and then say, I want to buy it at a discount that is significant enough to account for the reality that in the world there's uncertainty, there's volatility, there's things you just can't predict, and if I create a true dollar of value at 60 cents, then that's value investing, if you will, right? Mm-hmm. The specific discipline has had to evolve over time. If you go back and read about what Ben Graham was doing 100 years ago, there are certain things like net nets, or buying companies at discount to what you would get if you simply liquidated everything, right? That basically doesn't exist anymore. Doesn't exist anymore. Or if it does, it's once in a blue moon. You certainly can't have a business doing that. Yeah. Then if you look at some of the things that Warren Buffett did in the early part of his career, that too doesn't necessarily exist anymore in terms of sort of very easy money, discounts to intrinsic value. And there was a point in time where in some of these more distressed situations, and we're going to talk about it a little bit later, but in the 90s, I have a former boss that had an advantage because he could call up somebody in Delaware and get a sense for how some bankruptcy was proceeding by literally getting on the phone and calling somebody. And this is not from the 19th century. This is from not that long ago, where you still had certain things you could do like that. Warren Buffett famously got into quality and buying the likes of American Express and I think it might have been Apple and so forth, because Charlie Munger convinced him that under the right circumstances, quality is worth paying up for, which was one way in which his paradigm evolved. And then Seth Klarman also has his own way of doing things. And so ultimately, these paradigms have always had to evolve because the opportunity set moves, right? The things that used to be available don't anymore. Yeah. I think in the current period, people, a lot of what I call the mean reversion style of value investing is just less protected against competition from AI and quantitative methods. So in other words, if you simply say every 3 years there's a cycle in agriculture, I'm making up the specifics, but let's say agricultural stocks every 3 years there's a down cycle, or car companies every few years there's a cycle, and you sort of realize that you should buy at the bottom of the cycle and so on. Yeah. That is now hard to do in a way that's consistently leading to excess returns, to high returns, because people kind of get the actuarial nature of these very simple mean reverting techniques. So instead, you have to find value investing in ways that are less statistical in their analysis, right? You have to say that some version of SpaceX is cheap at 100 billion because it should really be worth 400 billion, or that OpenAI is cheap at 200 billion because it should be worth 500 billion. But if you're still doing it as quote unquote value investing, it can't just be to the moon just because I think Elon Musk is an amazing guy. It has to be some version of, no, there's this revenue that will come and here's why, and here are their gross margins, and here's a cash flow number, and here's why I think it's reasonable. And it also can't be a greater fool type approach where you say, well, I can buy for 200 because I know somebody else is going to buy it for 300. Yeah. Somebody can make money doing that, but that's not called value investing. Yeah. So the paradigm always has to evolve. In my personal case, I've been doing more and more in private markets, because I find that while they're very popular and sexy at the moment, they have certain natural restrictions to them. You can't just go on your phone and buy some of the things that I'm looking at, thankfully, at least for now, for my sake. And so those types of barriers, I find can create inefficiencies that in the modern era of public markets, where I can look up real-time quotes in Indonesia, is just a lot harder to do.
So do you think the value investing paradigm is evolving because the markets are getting more efficient?
It's intrinsic to it. I mean, I can rattle off dozens of examples. So here are 2 examples that have nothing to do with value investing. Used to be that when people did, so before you had AI, right, you had quantitative methods. So decades ago, people were using statistical analysis and other quantitative methods to invest. And you can read books. There were these 2 brothers, the Niederhofer brothers. And so when I was roughly your age, I went through a phase where I bought a bunch of investing books. And so you could read about Victor Niederhofer, Roy Niederhofer. And one of the things they talked about, that they used to be that statistically, if the stock market closed up on the Friday before a long weekend, what you might call a bank holiday weekend in the UK, there was a certain statistical relationship between how it closed on Friday and how it would open on, say, Tuesday after a Monday holiday. So you could statistically, let's just say, buy on Friday at the close and expect to make a small profit, but a profit nonetheless on Monday at the open by simply just buying and then selling. Okay. And the basic rationale for that was some version of some participants in the market are very short-term oriented, and so they're just trading, day trading type of thing. And so before the long weekend, they want to relax. They want to go, on their boat on the lake. And so they sell a little more for non-economic reasons, just to have a flat book. And so that sort of gets reverted on Monday when they come back from the lake and they want to buy back whatever. This last bit was not evident in the statistical analysis, but it's sort of a possible explanation for it. So that used to be a thing where you did on Friday at the close. And then it became you had to do it on Friday during the day because you had to anticipate the people who were anticipating it. And then you had to start doing it on Thursday. And I think at some point it just went away, right? And so that is not value investing, but it's a statistical anomaly that disappeared. Similarly, at an early point in my career, I did a lot of merger arbitrage. And merger arbitrage is when you buy the stock of a company that's being acquired by another company, and maybe sell short the stock of the acquirer. And you can go back in time, and people like Bob Rubin, that was at Goldman Sachs. Goldman Sachs was one of the places that pioneered sort of systematic and at scale margin arbitrage. So there was a point in, I want to say, the 80s where people could earn 20% unlevered rates of return from doing margin arbitrage, right? Then in the mid to late 80s, people started doing this at hedge funds, and the amount of capital that could do margin arbitrage increased, and so the 20% became 15%. When I started doing margin arbitrage in the early 2000s, sort of 2004 or so, it had become the, for quote, safe margin arbitrage, for something that wasn't super high octane, that the unlevered return you could expect would be around 10 to maybe 13%, okay? Today, you'll be lucky to get 4%, okay? Now, you would argue that if it's completely uncorrelated and it's, quote, pure alpha, that perhaps 4% is still a return worth getting. And in fact, people will today package that as a sort of a pure alpha product. Well, somebody will sell you the S&P plus 300 because they got to charge you a fee. But essentially what they do is they create the S&P through futures, some derivative, and then tack on this 4% merger arb and then charge you a fee and say, look, I'm always outperforming the S&P, right? So there's still perhaps a reason for it to exist, but the 20 became a 15, became a 10, became a 5, and that's, now you have to sort of reinvent the business. And value investing is the same. So you have to reinvent the strategy, because the nets aren't here in the same way, or the conversions of savings and loans, which was something that happened in the States in the 90s. Like, all these moments in time don't repeat themselves. The global financial crisis was something similar. People made fortunes investing in the claims into the bankruptcy of Lehman Brothers, or a few other things that you could have done at the time. So that's come and gone. So you have to find something else.
Yeah, I guess to build upon that, how has your investment strategy and philosophy kind of shifted? And were you once more of a value investor compared to now? Like, were you specializing in certain special situations, for example?
Yeah, so there's a pattern that I see, which is, as people get longer in their careers, they tend to switch to things that have greater compounding nature to them, and perhaps higher quality. Okay. So there's a investor that I greatly admire. His name is Bill DeHamel. He's a co-founder of a company called Route 1 Investment Corp out in California, and he has a lot of great quotables. One of them is, "Life's too short to invest in a company with bad management." He might use slightly stronger language at times, but the basic idea is, as a public markets investor, which is primarily what he does, you are to some extent reliant on management to do ethical things and to be good capital allocators, right? And so while early in his career, and certainly speaking of myself, early in my career, I might have found some really clever thing where it's like the market isn't looking at it, it's super complicated, and there's some bad actors, but you can still make money. By the time you're a little further along, what you really want to do, and it's not out of laziness, it's actually finding good investments. It's hard enough that you're trying to put yourself in a position where you find things that compound for years and years and years. So you'd rather find either a compounder that's cheap, or rearrange how you think about things, where you're willing to pay up a little more for something that does compound over time, rather than constantly trying to find discounted dollars in sort of really unattractive neighborhoods, right? Another very public example is Blackstone. So in the early days of Blackstone, they certainly were happy to do leverage buyouts of companies that had hair on them. But then when the leadership changed from Stephen Schwarzman to John Gray, one of the things that John Gray publicly, and I have friends who work there, so sort of one of the ways in which he changed or emphasized even more the strategy, is this idea of focusing on good neighborhoods, right? We don't want to be in bad neighborhoods. Whereas an earlier version of them might say, well, if I can get this really, the house on the edge of the neighborhood that in 5 years' time is going to be gentrified, that is a valid real estate investment strategy. But he's like, look, life's too short, and I'm running so much capital. I just want to buy an entire neighborhood, and I don't want to mess around with bad neighborhoods. So I think for myself, a bit of that, over time, I tried to do more, quote, compounders, and fewer things that require you to obsess, only to 9 months later having to move on to the next thing.
And like, what attracts you to like special situations in investing? Like, could you share like a particularly interesting industry example with us?
It's hard to say at a high level so special situations. So the investment industry has all sorts of jargon, and some of it is more unfortunate, some of it is less unfortunate. Special situations would be on the more unfortunate end, in my view, because it's such a generic term. It's like, aren't we all special? But it generally means something that's a bit more idiosyncratic, right?
Yeah.
So what's not special situations? What's not special situations is to say, I want to have a long short book where I want to in banks. So I work at some shop where my job is to own 30 banks and be short 30 banks, be completely neutral, and at the end of the year earn a certain return on that. That is one way to live life. I guess the special situations approach is that you're spending time looking at things that are a little more complicated, and it's sort of one-off, right? So it's less of a conveyor belt where you're looking at 1,000 things, and more of a workshop where you're sort of crafting something that's a little more delicate, fewer times a year. Okay. Mm-hmm. And some people like the scale of a factory. Some people like being the craftsperson.
Yeah.
Right. So if you're naturally drawn to wanting to be a craftsperson, I think it fits your personality. And so that's the case for me. To have 200 things or these big sector long short bets or whatnot is less interesting to me than to identifying some sort of nuggets of like, here's something quite unique, right? And then double click on that and try to find uniqueness within uniqueness, where the theme is unique and then the specific situation is unique and the specific security is unique, and if you put it all together, it's particularly interesting. I'll give you an example. Okay, so this is from years ago, but during the global financial crisis, I spent time looking at the banking sectors of certain countries that are stressed. In fact, if I'm slightly more precise about it, the global financial crisis hit in 2008, and then there was a period of a few years where we were recovering from that. And then there was sort of an aftershock, which is often referred to as the PIGS crisis, which is an acronym that stands for Portugal, Italy, Ireland, Greece, and Spain, PIGS. So 2010 and 11, these countries came to the forefront of people's concerns, investors' concerns, primarily because they had either property price bubbles or a lot of sovereign debt or both. Yeah. And so then you start seeing these sell-offs and people saying Greece is going to leave the euro. It's called Grexit as opposed to Brexit. And I remember ended up investing in Greek banks and other things as well. But so at one point I was looking at the Portuguese banking sector. And my initial conclusion was that it was not priced attractively enough for the risk, for everything that was going on in the country of Portugal. And at a much lower price, I would have liked it, but it was just priced as if Portugal was going to be okay, as opposed to Greece, where things were being priced to a very high degree of risk. So I like Greece as an investment. But then within Portugal, I found a very unique instrument. It was a bond that had been issued by one of the top banks in Portugal. But what was unique about it was issued in yen. Okay, and for major banks to issue in currencies other than their own currency is not that uncommon. You can find an American bank that issues in euros or sterling and vice versa, right? So to have a bank that issues in yen in itself is not a problem. But if you get into the math of distressed situations, the basic idea is this. If a bank goes under, then you sort of freeze that balance sheet at a moment in time. So this is what happened to Lehman Brothers, right? You freeze the balance sheet at a moment in time. And then you sell all the assets, right, in a liquidation. You sell all the assets, and you distribute the proceeds according to a hierarchy of seniority, right? The depositors, so the protected amounts, and then eventually the unsecured creditors, right? Which means that if the recovery is 42.5 cents for the unsecureds, all the unsecureds get 42.5 cents, okay? What's interesting is the interplay between that and the prices before you have a liquidation, because in general, if you have a bank that's stressed, people might say, well, instead of a 5% cost of capital, this bank should have a 10% cost of capital. Well, what that does is, so if you're still pricing it as a percentage interest rate, IRR, then the duration matters. Yeah. So in other words, in a simple world, and I'll ignore the compounding just to keep the math simple, a 1-year bond, and let's just assume zero coupon just to simplify the math, again, would trade for 90 cents. Whereas a 10-year bond to get to the same 10% IRR would trade, more like 10 cents, right? So again, just a very simple stylized example. The point being, duration to get the same IRR gets you a much lower cash price.
Yeah.
And so if this bank where one bond trades for 90 cents and the other bond trades for 10 cents does liquidate, and everybody gets 42.5 cents, the people that had the 90-cent bond lose money. The people that own the 10-cent bond make money. Okay? So the yen bond was extremely long dated and was in yen, and in general rates, so it's only at the time, interest rates in yen were lower, which meant they had a very low coupon, very long duration, very low cash price. On top of it, this bond had a relatively esoteric clause where if once a year, on April 6th, I think it was, once a year, it's almost like you go to the top of the mountain and you sort of see if the gods, once a year, you would measure the dollar-yen exchange rate. And if the dollar-yen exchange rate was at a certain threshold or above, the bond became immediately puttable by the investor. So you can immediately say, I want 100 cents back, please. Okay? So you have this option on the yen. Okay? And so because it was long dated, low interest, low coupon, at a time where, let's just say, the capital structure of this bank was trading for 70 cents, you could buy this bond for 15 cents. Okay? And if you try to price out, the option was a little complicated to price because it wasn't the traditional Black-Scholes, but you could sort of squint a little bit, do some fuzzy math, and conclude that the option was probably worth 20 cents. So you're paying 15 cents for something that has a currency option worth 20 cents. And if the bank fails, if let's say you get your magical 42.5, you get something 40 something back, you actually triple your money if at any point it fails. And your absolute worst case scenario is that over the course of 30 years, if the yen doesn't cross this barrier, if the bank doesn't fail, because in a perverse way, if the bank fails, it's actually good for you. But if it doesn't fail, you will have earned, I think it was 8% IRR over the course of 30 years. And to buy a 30-year 8% instrument was actually very survivable. Like nobody dies. And so that specific instrument, that really obscure situation, was very interesting to me because you have to understand. Because I remember early on when I was talking to investors about the PIX crisis, I remember being told Greece is uninvestable. Like for sure it's going to leave the euro, and then versions of that for Portugal. So you had to understand the macro. You had to understand the specific bank. You had to understand the capital structure. You had to understand the yen-dollar exchange rate, and then you had to somehow price an instrument on all this, on putting all that all together. And so that to me is a lot more interesting than to say, should I go long Citibank and short Bank of America or the other way around?
Yeah.
But like you said, during liquidation of that bank, every bondholder would get the same value.
Yes.
Why is that?
That's sort of rule of law. So essentially, think of it this way. So let's say,
like if I'm holding the long-dated bond and if you are holding the short-dated bond, we would both get the same value. If
we are both, say, unsecured, so using the language of credit, if we are pari passu. So the idea is, so let's say, let's try a simplified example. Let's say that we are both, we both have deposits in Metrobank, okay? And we both have certificates of deposit, so deposits that have a time nature to them. Let's say that mine comes due in a week and yours comes due in 2 weeks, okay? And then Metrobank blows up, right? And let's ignore deposit insurance for a second. Let's just say we are secured creditors of Metrobank, okay? The fact that my deposit was due in a week and yours was due in 2 weeks does not change how much money I get back versus how much you get back. We split it evenly. Because the rule of law does not say, just because my deposit was due sooner than yours, it's worth more, as long as we're both senior secured, okay? It's the same thing at the broad capital market space. If we're both senior unsecured, then we get the same. Okay, and so what that does is that in markets now you have these situations where if somebody's convinced that let's just say a bank, but it can be anything, it can be a real estate company, it can be anything. If somebody's convinced that a bank is not going to default, they may buy the short-dated bond because it's going to get paid at par as things move along, and then the long-dated bond is now left holding the bag on this still distressed situation because the first one got out before the fire consumed the entire building. So you're sort of saying, okay, I'm in a theater that's burning. How much more am I willing to pay for the seat that's 2 rows from the exit versus the one that's 20 rows from the exit? Because if I can make it to the exit before the other guy, I'm golden, right? If we're all in this together, then we both get the same treatment. I should come up with a better example than a theater on fire. But the basic idea is that if you're both inside the perimeter when it's determined to have been a failed institution, the rule of law says you're equal treatment. That's why everybody gets the 42.5 or whatever it ends up being. 42.5 being just a stylized number.
I guess to build upon that, we heard that you saw Credit Suisse absorption into UBS, an opportunity to invest. Could you please explain what opportunity you saw and how specifically did you make that investment?
So there's a number of different things that people were able to invest as a consequence of that. It was a version of, it wasn't the global financial crisis, but it was certainly a pretty impactful thing. There was a period in time where people thought that this could be the second coming of the global financial crisis. So it created a lot of uncertainty, and also, generally speaking, when something that's considered extremely safe goes from being considered extremely safe to being considered extremely unsafe in a hurry, people don't have time to gradually adjust. Anything that has to be done in a hurry can create dislocation, right? If you have 3 days if you have 3 hours to leave the country, you're going to pack whatever you can. If you have 3 months and you need to return your cell phone, whatever, like you have a lot more time to do things in an orderly manner. So when Credit Suisse imploded rapidly, a few things happened. For some portion of the world, some large proportion of the world didn't think it was going to implode, that you'd get saved or it would be fine. So that creates a market, right? If there's a difference of opinion. And even the ones that were of the view that it might may not have had enough time, or by charter couldn't simply get out of it. So what that does is it creates a big supply-demand imbalance, right? And that's one of the characteristics of distressed investing, which is a subset of special situations. So if you find some presentations, an investment deck trying to raise capital for a distressed credit fund, one of the slides they might have is something that shows the amount of capital that invests in investment grade situations versus in high yield, and I'll define these terms in a second. So investment grade versus high yield versus distressed. And the idea is investment grade is order of magnitudes greater than a high yield, and a high yield is much bigger than distressed. So investment grade is higher quality credits, okay? So HSBC is investment grade, the sovereign credit of Japan is investment grade, and so on. If you get to Altice, it might be high yield. If you get some over-leveraged stressed telecom, it might be high yield. If they then file for bankruptcy, or they're so stressed that they have to negotiate with creditors and they're now in a restructuring, the people that do that are a much lesser percentage of the total than the people who are willing to do a high yield. So what happens is when a company transitions from investment grade to high yield, there's a lot more people trying to get out because they can't hold high yield, because by charter they can only hold investment grade, or they only want to a much smaller number that can hold high yield. So that creates some dislocations. And this thing happens again from a high yield to distress. If you go straight from investment grade to distress, if you sort of skip that interim step, it's even more pronounced. Like, depending on how you want to look at it, it could be sort of a 100x type relationship, where there's 100 times more sellers than there are buyers at that juncture in time. And that's one of the characteristics that can lead to a mispricing. If you have somebody that has to sell no matter the price, whatever it is, there's a movie with Eddie Murphy and Dan Aykroyd from years and years ago called Trading Places, where at the moment they sort of, minor spoiler, they artificially create sort of a crash in the market for, I think, frozen orange juice concentrate, so like a commodity. And it's this old school in the movies, you have the open pit where a bunch of mostly dudes going like, buy, sell, right? And so they artificially create this thing where everybody's panicking and selling, and then the two of them are like, I'll buy, right? And that sort of illustrates in a humorous way the positions that the one can be in if you can exploit these asymmetries, which goes back a little to what I was saying earlier about the global financial crisis. If you want to be Eddie Murphy, right? You want to be the Eddie Murphy of that. You don't want to be the people that are like, oh, this is going to go up, and then all of a sudden you're a forced seller. But if you can be in the Eddie Murphy position, then good times, right? So a bit like that in these distressed situations, like Credit Suisse, if you can not make the mistake of catching the falling knife too early and wait until it's now in a severely dislocated position, then it can be quite interesting. So the securities that I found I thought were most interesting were something called the AT1s, which sort of a technical explanation, but essentially it was a part of the capital structure. It was senior to the equity, but junior to everything else. And famously, in the case of UBS taking over Credit Suisse, it was wiped out while the equity still got something. And that was, it wasn't necessarily completely obvious, but it seemed rather unusual and and breaking from a lot of applicable law, from a lot of precedent. And if you then drill down on how the world found itself in that position, there's actually a lot of very sort of concerning facts from the standpoint of what the authorities chose to do, where they said the bank was solvent on Friday, and by Monday it's taken over by UBS. And while it was solvent, they sort of say we still have to wipe out these securities, which is inconsistent. It would seem that they had to change the law over the weekend, which is also a pretty dramatic thing to do to make it all sort of justifiable from a legal standpoint. And while all that is interesting, a key element to this is that at the moment of maximum uncertainty, you could buy these securities for literally 1 or 2 cents on the euro or the Swiss franc or the dollar, as the case may have been. And that's another element of investing where you want to create situations that are very asymmetric, where your upside downside is in your favor. It's like, this is almost an interview question that one can have. I may have used this as an interview question. There are situations where even if the expected value of something is negative, so in other words, even if you think you're going to get 0, but there's some chance that you might get more than 0, there's the price at which you should be willing to buy that, right? So if there's a 25% chance of you getting 50 cents, but a 75% chance of you getting 0, at a minimum, you can do sort of the weight probability of the two and say there's a price at which, just the risk neutral price for that, right? But even before you get to the risk neutral price for that, you can say, well, but what's the path dependence here? How will the facts change? What sort of convexity? What happens if there's, as opposed to a static game where it's like, this is the probability, this is the up, this is the down. It's a little more like the types of card games where you get to see more cards as you go. Yeah. So if you're still at that table, to overextend the analogy, and well, I've just bought myself the right to see a few cards, and the cards are probably not going to make the 0 any lower than 0, and maybe it'll make the probability a little lower, but I'm already paying so little that, okay, if it goes from 2 cents to 1 cent, but as long as I size it appropriately, I wouldn't put my entire net worth on this thing, right? Because 2 cents to 1 cent is still a big percentage difference. But if you just say I put a little bit of money in it, and I think there's a good chance I might make 5 times, 10 times my money, and a good chance doesn't have to be that high if you think it's for 10 or 20x, even with a great probability of losing. It's a bit analogous to how people do venture capital, right? So statistically, the vast majority of venture capital investments are going to fail, but if you can get 1 or 2 or 3 that are 10x or 20x, as a portfolio, it is actually a very rational thing to do to make these investments. So similarly, these highly convex bets that you can find in moments of great uncertainty can pay off rather well. And that's essentially what happened, where over a relatively short period of time, there was an attractive payoff from making that investment.
And like you said, the AT1 bonds, like didn't they have a clause like the government could wipe the bonds totally during the...
Yeah, so the CS AT1s did have a clause that allowed them to wipe the AT1s. What the clause didn't say is that you could wipe the AT1s and keep the equity outstanding. Okay. And so if we came to work on Monday and the government said we're wiping out the equity to 0 and we're wiping the AT1s to 0, that might have been more like fair play, okay? So the fact that they didn't wipe out the equity in the first order was like one of the first things you anchor to. It's like, wait a second, if the equity's getting 3 billion and I'm getting 0, if I got those 3, if the AT1s got to 3 billion, that was a 20-cent recovery. And again, you're paying 1 or 2 cents, right? So at a very simple, it's like, well, there's this absolute priority, this idea that the equity is junior to me. How come they're getting something? I'm not getting something. Yeah. So if you could litigate that or negotiate that, that's one thing. But then there are other elements to this. So for example, you could argue that the AT1s, because ultimately Credit Suisse wasn't liquidated, it was taken over by UBS. You could have theoretically, I'm not saying that you had, a high likelihood, but you had a non-zero likelihood. You could have argued, well, actually, this should travel to UBS. This security should travel to UBS because we're not bankrupt. If this becomes a AT1 of UBS, then you're getting par, give or take, right? So then it's 50x, right? Yeah. If there's a very small probability of that happening, that still has economic value, right? And then there's a few other things that you could have said. So, for example, the line was drawn in such a way that the CS AT1s got exactly 0. But the thing that was senior to them by $1 got exactly par, got exactly 100%. So the line was drawn magically, so that you get 0, and then but not 0.1, not 2.0, and then everybody else that was senior to you got completely repaid. So you could argue that that was artificial. Yeah. And so what happens is when you have 3 or 6 of these things where you say, well, that just seems a little fishy to me, and I can go and litigate it at a minimum or attempt to negotiate for a better outcome. Yeah. As long as you have staying power, as long as you can pay for the litigation and so forth, then you have a path dependence. And it's again a bit like, okay, we get to see more cards that may improve my standing in this. So, for example, at that point in time, one of the cards that was available to several investors that did this strategy was to say, well, we get to sue in, say, New York State. If I own dollar bonds that aren't in New York law, we get to sue in New York, and we get to depose, the head of the central bank of Switzerland, and maybe the head of UBS at the time, and maybe somebody in government like the minister of finance. And if you are these very senior people, and some awkward things may have been written and text messages may have been said orally, but still under testimony, to settle all of a sudden becomes slightly more interesting if you're that politician, right?
Yeah.
Because you, like, heads, I go to jail; tails, I don't go to jail. What does that cost me? Nothing, because it's not my money. So there's all sorts of ways in which you can put yourself in a favorable position, as long as you have multiple ways to argue that security was treated in ways that are unlawful or otherwise in breach of contract, in breach of applicable law, etc.
Perfect. Yeah. And we noted that you also founded Project X, a
Yes.
life sciences and healthcare investment firm.
That's right.
What drew you to the life sciences sector, and what is the vision or story behind Project X? And how does this compare with your background in value-based and special situation investing?
Yeah. So it's great that it's almost a callback to some of the things we've talked about before, because to me it's a move towards quality and long-term compounding
Okay.
rather than short-term trying to find some
Just
bond trading at a
yeah.
discount. So the genesis of that interest was I moved to Boston in 2008.
Okay.
At the time, to get a job as a value investor at Baupost. But as I tell the stories, if you're in Boston and you go to dinner, and the person to your left, you can have a conversation about whether Lehman Brothers claims should recover 32 cents or 38 cents. The person to your right is growing hearts in the lab made out of human tissue for future implantation.
Yeah.
No offense to Lehman Brothers, I'm going to go talk to the guy growing tissue in the lab.
Yeah.
And so it became a personal interest of mine to sort of, and also my circle of friends in Boston has a lot of these people that are quite literally growing heart tissue
Okay.
or modifying viruses to cure, cancer and so on and so on and so on. So started as a personal interest, but I couldn't turn off my investing brain. So over the years, it became something that I would invest in, or I would advise some of these companies, or raise SPVs, special purpose vehicles, to invest in some of these companies. And then at one point, I had the opportunity to raise a fund that invests in this sector, and the client base for that fund is essentially very successful families that don't necessarily feel like they have the relationships or the knowledge to invest in the space themselves. So the archetype might be a family that made their money in real estate in a foreign country, in South America, say, and they're extremely competent at what they do, and they realize that over the next 20 years, 30 years, there's going to be a lot of innovation in quote-unquote biotech, but they're sitting in São Paulo or somewhere in South Africa, wherever the case may be. They're not on the ground being exposed to this, and they don't have somebody at the hospital such and such to call. So then I become their eyes and ears, and I deploy capital into this space on their behalf. And what I told them at first is like, some version of tongue-in-cheek, come back in 10 years and we'll see how well I did. But let's not, worry about the next 3 months or 9 months or even a year. And so that's, in a sense, quite different from trying to find these distressed bonds. I had the advantage of, by the time I started that business, having nearly 15 years in Boston, building this network, and then having made these investments in these advisory roles and so on and so on. And then last but not least, generally speaking, the people that do medical innovation investing are of the growth mentality, right? Mm-hmm. It's like, this will be the next X, the next Y, and it's all going to be worth a lot of money, and let's not worry too much about Excel spreadsheets. I'm generalizing a little bit for effect, right? So if you come to it with a bit of a value investing angle, you might find yourself identifying situations that fall through the cracks. Okay? So oftentimes, and I like to think also in terms of competitive advantage, where or in investing terms, they sometimes say, why is the $20 bill on the floor for me to pick up, right? So why would I be the person more qualified to do this? And if it's a situation that somebody has 2 PhDs from Harvard, has to sort of write 20 pages to understand the science, I'm unlikely to have a competitive advantage against the investor that has highly trained technically. But if it's something that has a bit of a mispricing element to it, maybe taking these tools from elsewhere and deploying them in this world that otherwise may not see the deployment of these tools can be helpful. There's an example from started in 2019 and I got monetized this year. It was a medical device that sat inside of a large pharmaceutical company. The large pharmaceutical company was going to just stop selling it because they were making $4 million a year in sales from this device, which if you're a large pharma company is essentially zero.
Yeah.
And so they were literally going to shut it down. But the device did what it was supposed to do, and the doctors that implanted it really loved it. It had clear clinical benefit. And so I and other investors as a group, we backed an entrepreneur that took the device out of the big pharma company and built a company around it. Now it's the healthcare industry, I think anywhere, but certainly in the United States, is highly regulated. So you can't just say, okay, I'm just going to start manufacturing this thing. So it takes years, right, to basically build a manufacturing operation that meets all the criteria from a safety standpoint, gets all the approvals. But on the other side of that, a couple of years later, you do have something that now can manufacture this correctly. I think when the lights were turned back on in the business, within, I want to say, a month, we were selling more of that device than the big pharma company ever did, right? And there was a whole investment memo worth of analysis here where we felt that the large pharma company had a penetration of as little as 1% of the addressable market. So there are a lot of ways in which you could grow it. They were the team at the large pharma company was essentially somebody that would pick up the phone if you called asking for the device, and somebody that would walk down to FedEx to ship it. Like there's just no commercial organization. So long story short, we could take this device that was basically written off by some very smart people in the industry, and 5.5 years later, we sold the company for actually $200 million, right? So it was ended up being a very attractive outcome for our investors and for myself personally. But it started with something a lot of smart people said, this is outdated technology, it's not going anywhere, it's very small, let's just shut it down. And so to hone in on that was certainly not what some of my good friends that are growth oriented, what's the latest sexiest thing that you can do, like they might be looking at these modified viruses or gene editing technologies, all of which are very interesting. This is technology that was tried and true, had been around for a while and was sort of written off, right? And so maybe if I can do that a little bit, at a minimum, it's diversifying away from a portfolio standpoint, and perhaps it's in of itself worth doing to get attractive returns. So I try to complement the more traditional exposures to the long-term growth drivers in the sector with some of these things that are very value-y, but in life sciences innovation.
But to invest in the healthcare industry and the pharmaceutical companies, you don't really need to understand a lot of diverse subjects like biology, chemistry, etc.
Yeah, so that's probably the number one question that I get is like some decision tree is like, if you don't have a PhD from Harvard, then I won't take your call. So two-part answer. First part is, if I look at the people that are the best investors in the space with like the best track records, I would say the ones that have the PhDs from, I'm going to stop picking on Harvard, they have the PhDs from Stanford and so forth, and from Imperial, right? That's the one I should use. The ones with the PhDs from Imperial. So the top investors, I would say they're a little more than half, but they're not 3/4. So in other words, gun to my head, I would say somewhere in the ballpark of 40%, 40, maybe 45% of the top investors that I would consider if I had my little spreadsheet of who are the top firms and top individuals in this space, just under half are people that don't have that level of technical expertise. So that's observation number one. Observation number two. If you were to invest in the oil and gas space, which is a very different animal, but hear me out. So oil and gas space is also extremely technical, right? So there are people that spend their entire careers to get PhDs in just how reservoirs are structured, or how to drill, or how to maximize the late life performance of an oil field that's underwater versus underground, and different answers, different PhDs, right? Yeah. If you are an oil and gas investor, nobody expects you to have a PhD in reservoir engineering. Okay, what you're expected to have is a broad understanding, right, and the ability to hire reservoir engineers or whatever other technical expert you might need to complement your general knowledge, and they give you expert information, expert opinions that you fit into your mosaic, and then ultimately you make an investment judgment. That is true in a highly technical field of oil and gas. That is also true in other fields that have highly technical components. So for example, a lot of investment opportunities I can think of have a litigation angle to it. So I will hire a highly trained expert, also known as a lawyer, right, to give me opinions on whether I think that under Swiss law, the CS AT1 is this or that, or under New York law, the CS AT1 is this and that. But nobody would expect me to have degrees in both Swiss law and New York law to simply make the investment. It is sufficient for me to say, I've been doing this for a while, I kind of understand it, here's why, look at the track record, look at the things that I've done, and I've hired some of the best lawyers in those specific domains. So I find that that's true in healthcare investing as well. And even, so here's how it all comes together, right? Even if you look at the firms that have the PhD from Imperial as the guy at the top, if they're 45 or 50 years old, that PhD is now 2 decades old. So whatever they learn in that PhD is completely outdated, right? And how do they run their business? Well, they're going to have domain experts. So they're going to have, Peter's going to have Johnny, the oncology guy, and Jane, the ophthalmology girl, and so on and so forth. And their technical training perhaps will make them better at having technical conversations with these domain experts. But they're still following the model of having domain experts that are on top of the latest trends, that perhaps study those domains much more than that senior person ever did. So the challenge for me is to keep learning, so I stay on top of what's the latest and greatest, and be able to compete with people that have more technical background. But then when you start looking at why is it 40-45% of the best don't have that technical background, I start realizing that even in a field like healthcare investing, it's not just a spreadsheet. The spreadsheet is 25% of it, right? And very quick example, one of these great investors that I admire that does not have an advanced degree, but has one of the best track records in healthcare investing. One time I was in his office and he was telling me the story of how he just bought a position in a certain company. And I asked him why. He's like, well, I've been following this company, and the technical perspective is we think that their science is just as good. I'm just going to call them Company A and Company B. So Company A has basically science that's somewhat similar to Company B. But Company B was trading at a valuation that was like 10 times. So that to me was like an interesting mispricing. But that wasn't enough for me to do that. So I did the technical analysis, technical in the scientific sense, and I concluded that the fact that this was trading for 300 million market cap and there was a 3 billion market cap was not justifiable. That wasn't sufficient. What made this guy actually invest in the 300 million Company A was that the news came out that Company A had hired a new chief scientific officer, who was this woman that my friend really admired. And he basically said, if this person left this other company where she had a good seat, making good money, with a lot of options for that company to be successful, for the $300 million Company A, she must have seen something that really interests her. And so, and that's, I don't know what you would call that. That's human factors, that's qualitative. But this is a highly technical individual so this is an individual that's been in a highly technical field for 20 years with one of the best track records in industry, and he conversed with you about the specifics of different types of lentiviruses and so on and so forth. But ultimately, he made the investment when he knew that Jane had joined as the chief scientific officer.
That was a great insight.
Yeah.
I guess in terms of like the investments in healthcare and biotech, there could be a lot of like ambiguity in terms of, for example, clinical trials, etc. How do you look at that when you're investing in those kind of areas?
Good question. One of the answers is you do look at it as a statistical process, a bit like what I was talking earlier about venture capital, where if you have 20 things in your portfolio, all of which have a 20% chance of success, let's just say, then you kind of know that the vast majority of them are going to fail. But then the other question that you have to ask to determine, almost like an interview questions, like you have 20 things in your portfolio, they all have an 80% chance of failure, they're all uncorrelated with each other. What else would you need to know to buy this portfolio? And the answer is, you need to know for the ones that don't fail, how good is it, right? Because if 80% of the time you lose all your money and 20% of the time you double your money, that's not very interesting, right? So the 20% of the time where you do make money, it has to be a lot more than just doubling your money. Whether that's 5x or 10x, we can start, then you can start having a conversation, right? And you start seeing how in different areas of healthcare innovation, there are different probabilities of success, but also different payoffs, right? So fields that are very hard to have a successful clinical trial in, but have these immense payouts if you do succeed, that can be worth doing. Fields that are more lower risk, low reward can also be worth doing, right? What you don't want is a field that fails all the time with modest gains if you do succeed, right? So you try to solve that, and you try to have a portfolio, and then there's some nuance to it, which is what you're trying to solve for is moments in time where you kind of know, not in the inside information sense, but you sort of have a lot of conviction that that situation is mispriced, that the world is saying this has an 80% chance of going belly up, and you sort of say, no, it's actually the other way around. It has an 80% chance of working. And that happens frequently. And if you look at some of the best investors in the space, that's quote unquote when they sort of put a lot more chips in, go all in, because there are moments in time where you get those types of insights. So I'll give you an example. A friend of mine, very successful investor, he has a portfolio that is about 80% public markets, 20% private markets. Okay, so 20% are private companies, pre-IPO, 80% is post-IPO. But he says that he spends roughly half of his research time on pre-IPO companies. Okay? The reason for that is the pre-IPO companies can give you a lot more information, because in the public markets, there's limits. Everybody needs to get the same stuff, right? So you get the same. So the pre-IPO companies give you a lot more information. And they don't live in a complete vacuum. So let's say you're looking at a certain type of eye cancer, right? And if you're looking at this type of eye cancer or a type of brain cancer, if you are able to look in depth at 12 startups, 12 private companies, they're all going at it in different ways. You may be able to look at the 1 or 2 or 3 public companies that are in an adjacent area and have a perspective on their science that is different from somebody that just downloaded the one PDF from the website and spoke with a couple of doctors, right? So you can have a differentiated insight by bridging between public markets and private markets in ways that are completely lawful, right? There's nothing in the law that stops you from talking to different companies altogether and understanding how their science works, right? So there's things that one can do that can create little high conviction moments. I think that's a very important part of how you make the game work. But ultimately, you have to have diversification. Like, I would never do biotech companies with a hyper concentrated portfolio. I know people that do, but they do it in a way that requires fortitude and a very high degree of confidence in yourself. Most people that I know do it because of this high failure rate, but high reward when you don't fail, with some degree of diversification.
Great. So as a distressed situation investor, what is your approach to distinguishing between companies which are kind of uninvestable and companies that may be struggling but will have value to them in the future?
So just to be persnickety, I'm not sure that's the A-B. I'm not sure that's, so something can have no value in the future and still be investable, okay? If it has some value in the present. Okay, here's what I mean by that. So if a company is shutting down, this is not the most glamorous form of investing, but it is a form of investing. You can say this company is shutting down or it's going to be out of business in a year. But if it can be invested for that year, or you shut everything down, sell the parts, sell the furniture, and you make some money from it, some people make a living from that, right? So it doesn't. So you can have a company that has no future but still has present value, and that can be sufficient, right? But I think to the core of your question is like, how do you figure out which ones are worth investing in versus not? So my framework, a few things I look at. So one is, what I have found is that the world, linking some of the things were said earlier, is very competitive. And so the things you could do 20 years ago, the easy money things don't exist anymore. And so you have to ask yourself, if something has the potential to deliver excess returns, why is that? Okay, so in public markets, I find that it's become more and more competitive, and so oftentimes, a lot of the situations that seem to have very high returns, they have political risk or regulatory risk or legal risk, things that are perhaps a little harder to price by a machine, right? So there's a lot of situations where you find yourself, there's going to be an antitrust case in the situation, or there's some government that will rule in your favor, but maybe they won't, right? So there's a lot of that. So while that's not necessarily the end of the world, I find those things to be hard to do consistently, profitably. So I much prefer to find themes where the world is not investing in them for reasons that I can identify and sort of say, okay, this makes sense to me. So I'll give you an example from a couple years ago. This changed at a minimum post the Trump election, but perhaps other factors as well. But if you go back in time a couple of years, then ESG was very much popular, right? And renewals was the future, right? And so oil and gas, any sort of investment in the oil and gas industry was actually earning significant excess returns because a lot of the world was either unwilling or unable to do so. So if the University of XYZ decided that we will no longer invest in fossil fuels because we want to make the world a better place, they're entirely entitled to do so, but that means that they've dropped off completely. So at no price would they ever invest in oil and gas and fossil fuels, right? And if everybody else does that, or if enough people do that, then to try and find somebody that will do oil and gas becomes a lot harder, and the people that are willing to do it may say, I need a little more excess return for it, right? While I'm not advocating for environmentally destructive policies, I do believe that we're not about to do away with oil and gas anytime soon, and there are ways to do it that are environmentally sustainable, or at least where the damage is highly managed, and other ways that are reckless. And so you can maybe focus on the ones that have a little more manageable impact on the environment, and say, well, I don't. Here's a simple example: jet fuel. Like, we're not going to have electric planes crossing the Atlantic anytime soon, because the math of the weight of battery is just it's like if you like going back home, then you need to get on a plane that's going to have jet fuel, right? If I like going back home, I need to get on a plane with jet fuel for a long time, right? So somebody needs to make jet fuel, right? And so if you need to make jet fuel, it makes no sense to make just jet fuel, because the way the refining works is that you have to make a bunch of other sort of lower grade oil and gas things, right? Using not technical language. But so then what's the purpose of those? And of course, then cars are not going away. We now see a backlash against EVs. But long story short, if you go back to the period 2-3 years ago, this is almost a comical example to me. I remember meeting this company that was looking to do the shutdown process for oil and gas fields in the North Sea. Okay, the North Sea, sort of Scotland, Norway, is probably the most regulated and quote unquote cleanest area of the world to extract oil and gas. Because it's first world European nations that are essentially, we don't want any spills, we don't want any worker unsafe situations, everything's super regulated, super protected. So the standard in the North Sea is if you are done with a well, so you extracted all the oil and gas out of that well that you think you will extract, if you sort of walk away from your concession, the standard is that oil company has to put in, let's just say, cement down the hole that is thick enough, enough of the depth of that hole is now filled with this very sort of capable cement-like substance, that you can have a very severe earthquake and there's still no spillage of oil ever coming up from that dead well. On top of it, you have to remove all the equipment that was at the bottom of the ocean. So this is oftentimes you're maybe 1,000 meters down, 1,000 meters of water, and then maybe 2 or 3 kilometers underground. So you have to seal the hole and then take everything that was 1,000 meters down, send robots, send divers to remove the stuff. And then all the stuff that was at the surface, or the rig that was at the surface, has to be taken somewhere where it's decontaminated and recycled and sort of done away with in a way that's environmentally sensible. That's the standard. And for a long time, all these big oil companies in the North Sea have been accruing these reserves because they're required to accrue the reserves. So when the day comes, they can go tap into these reserves to pay for the cleanup and finishing up these wells. So this company wanted to compete for these projects. And in order to compete for these projects, to shut down and clean up oil wells, they need to show that they were well capitalized, because they're competing against some other large operators. And they couldn't find the capital to do it. And I asked them, so how come? It's like, okay, so it seems to be a profitable business. Seems like there's a lot of demand because the North Sea has a lot of these older oil wells from the 1970s. So there's going to be a lot of this needs to get done. It's a profitable piece of business. You people have the technical expertise. And the answer finally came back that the one issue they were having, first and foremost, was that because their business was oil and gas, remediation and cleanup, that by the time they got to gas, people were hanging out the phone, because it's just, at that point in time, oil and gas was uninvestable from a charter standpoint, and the nuance that no, we're helping solve the problem, we're cleaning things up, did not allow them to fall outside of the boundaries of what constituted uninvestable. They were still uninvestable because technically it was still fossil fuels adjacent. And that's of course absurd, right? If you're like shutting down, cleaning these things, that should be subsidized, not uninvestable, right? And so I try to find things like that where I can point to it and I can say, okay, I can point to why I could earn an excess return doing this thing because other people are not willing to do it for reasons that I can disagree with and be very comfortable disagreeing with. Yeah. Right? So that's one example. I'll give a very simple example. At the moment, I like a lot of investing in countries that are on the eastern part of the European Union. So countries like Poland or Latvia, Lithuania. And what I find is that there's still a lot of capital that some guys sitting in New York, and they go like, well, wait a second, Latvia, Lithuania, isn't that part of the, wasn't that like a Soviet thing? So they haven't been there in decades or just have this mental image from when they started their career. And then someone else might say, well, that's next to Russia, it might get invaded. If you go to Latvia, Lithuania, or Poland, I find them to be vibrant economies, right? And yes, you have to understand the rule of law, and yes, they're not corruption-free, but I could say that about Italy or France, and if you gave me a choice between investing in southern Italy or Poland, I might choose Poland, frankly, from a rule of law and corruption standpoint. So it's sort of a broad brush that a lot of people are painting with for historical reasons that are lagging, or then you have this political risk of, will Putin roll tanks into Warsaw? And that's slightly more nuanced, and I would admit there's perhaps a chance that's not zero of some political situation like that. But would I be comfortable putting some percentage of my portfolio that's significant, but not the entirety, into those countries? Because I still don't think it's extremely likely that you might see a Russian invasion of Poland. Yeah, I feel like I could put some money in Poland, and not so much that if there was an escalation of political risk, I would be bankrupt, but enough that I get to succeed or have a significant loss if the country is invaded. I think that's okay. So that to me is another example of something I can point to, is I can talk to people and say, I don't invest in Poland because it's Eastern Europe. I don't invest in Poland because it's corrupt. Well, it's not anymore, right? Or not to the scale that you're thinking, and so on.
That's great.
Interesting.
So next question is like kind of advice for all the audiences and for us as well. So at Imperial, a lot of students are particularly interested in technology and AI. We see you also invested in XAI, Elon Musk's AI startup. Does your approach differ when investing in technology?
Sure. I mean, it's more like what I was talking about, the life sciences innovation, where you're trying to solve for, you have to think a little more creatively, right? So I think part of the reason why in this world of quantitative methods, growth investing, venture capital has survived as a more human-heavy form of investing is that, at least for now, it's still hard for a computer to determine the value of something that's never happened before, right? So SpaceX, it's like, okay, you sort of have to say what's the value of a company that will colonize Mars, or more likely that will have a much cheaper sort of satellite business, and then the Starlink and so communications, and maybe the short flights to Japan and back and so on. But it's still a more creative exercise than saying, okay, how many cans of Coca-Cola will be sold in the world next year, and what do I think that's worth, right? So the more you get into the creative, this hasn't happened before world, it just, at least again for now, there's still a role that humans seem to be able to compete versus machines doing that. So technology, you sort of have to put yourself in a position where you think creatively. The business models are very different, right? So I have friends that are far more successful than I am at investing in tech businesses. And it's sort of the classic, this company has like no cash flow, no EBITDA, loss making, and it's like, yeah, this company should be worth 200 billion. It's like, but how, why? And well, because if you look out 4 years, the revenue is going to be this much, and while they'll continue to have very low margins because they're going to keep reinvesting in the growth, they're a software as a service business, and we kind of know that if they just pressed the button and stopped growing, they could run it for 83% gross margins, and that means they'll get this much in cash flow, which at a 20 times multiple, because of the stickiness of software, you get this valuation, and so therefore it's cheap. So it's sort of a different model altogether. I don't do a lot of that, The X.AI bit, I think the angle that I may have had there is this idea of identifying mispricings, and it was, in hindsight, I should have done a lot more of it because it's done extremely well so far. But what I identified was this idea that I was sort of mostly riding this trend that we're now seeing very visibly of these pre-IPO tech companies, where simply having access actually has a lot of value. So I don't know how much you've been following this, but OpenAI, Revolut, X.AI, SpaceX, all these sort of sexy pre-IPO companies that are tech, the valuations have been going gangbusters, right? And there's even an entire business of people that are extracting economics from access to blocks of this. So in other words, the commissions on buying shares of Apple have gone to zero, practically speaking, near zero. But people are extracting commissions that are very significant from finding supply in OpenAI or X.AI, whatever, and then finding a buyer and a seller, and then they sit in the middle and they collect commissions that, as a percentage, haven't existed for a really long time. And so my little angle was to say, well, look, I don't know if X.AI is going to be worth 100 billion or 200 or 300 billion. And frankly, I don't have the framework to value it in those terms. But it feels to me that there's a structural mispricing here because I, due to relationship, had access to an early round, and it just seemed like that the market was valuing these. They're always doubling, tripling every 6 months. And so putting a little bit of money in, my worst case scenario would be that little money that I put in doesn't go anywhere, and now it's worth a lot more. So it's just, it was navigating that sort of theme of the pre-IPO tech companies.
But do you think these kind of, the strategies cause speculative bubbles?
I don't know if, so cause and effect, causality, so that's sort of strong language, right? So the famous investor George Soros has this theory that he's written books about. He calls it reflexivity. So reflexivity, so if I do it in mirror image, is essentially two curves, right? So there's the actual curve of the underlying technological progress, and then there's a perception curve that at first lags. So it's like, oh yeah, this internet thing is kind of a joke for like people with no social skills to sit at home, drink Mountain Dew, and play around with. To eventually, oh, maybe it's very impactful, and then you have the peak hype, right? When people say, these companies should be worth bazillions of dollars, and then it's like, oh, it turns out they're not growing teeth, right? It's not everything, right? And then you have a period of adjustment where perhaps the perception overcorrects to the downside, and then eventually have a stable, mature industry and it's sort of stabilized, right? So the whole Soros reflexivity theory is you want to get in just, frankly, I think his approach is just as the hype is getting really started, right? And then you, in a very non-value investor sort of way, you actually ride the hype where you're just like, look, people are just crazy. The valuation is going out. I'm not going to try and put a multiple on this. I just have no idea, but I'm just going to keep riding this craziness. And then when I see the craziness, seeing some self-doubt, that's when I get out. So it's almost investing on human folly rather than anything else. But George Soros is worth tens of billions, and I'm not, so the joke's on me, right? So it works really, and not coincidentally, he's now still alive, but he's, I think, in his 90s, so I'm not sure that this is him personally doing the investing, but it's known that sort of Soros's vehicles are doing exactly this, right? And I know of at least one very well-known sort of long-only active manager from the US, household name, that essentially internally they're of the view that AI is in the bubble, but they're not changing their allocations, right? They're still long all the names. So yeah, I think it's not it doesn't necessarily cause, and these bubbles aren't a certainty. It would seem that whenever we have these transformational periods, that they are likely to develop. And this is different from entirely speculative bubbles. So there's the Dutch tulip craze or a few other things like that, where the world didn't change because of tulips, but you still had price bubbles, right? So this AI bubble is very much like the Soros reflexivity version, which would be like the early internet or a few others, where truly there will be some sort of societal change, whether it's worth bazillions of trillions of dollars or only trillions or less. That's where the debate and the possible speculative bubble exists. I'm not personally super invested in AI because I can't make sense of the valuations. But so the X.AI I did early on this sort of other thematic approach, and it sort of put me exposed to, it gave me some exposure to the AI theme, which there's a friend of mine coined this term called an emotional hedge, which I think so a guy from Boston, and the basketball team, the NBA team in Boston is the Celtics. And so he would oftentimes place a small bet against the Celtics. And he would call that an emotional hedge. So the idea is, if the home team wins, if he's a fan of Arsenal and he bets against Arsenal, if Arsenal wins, he's happy because Arsenal won. Yeah. If Arsenal loses, he makes whatever it was, £500, right? So that's an emotional hedge. So even though the valuation of all these AI companies I struggle with, I in a sense have an emotional hedge, because as long as these things keep running, I'm making some money from this one exposure, but I can't begin to explain why the current valuations are the right ones, but people have made a lot of money from it, so the joke's on me on that.
And I guess to end today's episode, do you have any advice for ambitious students that are interested in investing, and maybe how they could start?
Sure. Two part. Part one would be, I've underappreciated the importance of really liking what you do. And I don't mean this in a touchy-feely sort of way. It's like, if you are absolutely passionate about, so I'll use a sports analogy, not that forgive me, but a sports analogy. Let's say you're absolutely passionate about the sport of fencing, and there's a lot more money to be had in football. If you are a pretty average football player, you are unlikely to ever make a living for football. You're not likely to become a multi-millionaire for football. If you are the world's single best fencer, or in the top 3, you might go to the Olympics, you might turn that into an endorsement, you might become a motivational speaker from it. You might actually make a living that is not amazing by football player standards, but that is very, very good, okay? And you'll be much more fulfilled. I don't know anybody that is really good at a certain type of investing that did it because they wanted to, because that made more money than the other thing, right? Yeah. So the word that I often use is congruence. You want to find something that is congruent with you. So if you read somewhere that distress investing is cool, and you kind of don't have no idea what it is, but it's like you start convincing yourself that it's the thing to do because, I don't know, maybe you can make money or something like that, and then you wake up in 3, 5, or 8 years and you just don't like it. Chances are you might be quite good at it, but you're never going to be the absolute best at it. So first piece of advice is find things that you're really into, right? Maybe there's some element of moderating it, because if you're really into something that has intrinsic characteristics that makes it hard to work in that field, then maybe you have to think about it. But don't underestimate the importance of really liking something to actually be good at it. And if you're not good at it, it's just going to be a slog, and you're never going to be distinguished that much in that field. Yeah. So think about what really interesting, and it could be, I'm really passionate about emerging markets. I'm really passionate about going back to wherever I grew up and doing real estate, and other people can do AI. I want to touch the things that I invest in, and so on and so on and so on, right? So then, all that being said, so then if you have somebody that says, yeah, Miguel, I hear, I just want to get to investing. So there's all sorts of different types of investing, and people that do real estate in central London, that's a form of investing. That's very different from crypto. That's very different from investing in AI, which is very different from, I know people that have made fortunes in oil and gas today, or stuff that's been around for hundreds of years. So I've seen this go a few different ways. If you grew up absolutely like you're some sort of a savant, and since the age of 4, you always knew you wanted to trade bank stocks, good for you. If you grew up in a family where the entire family business has always been oil and gas, and you kind of know, you're passionate about it, good for you. For most people, you have no idea, or you have some idea, but it's a hypothesis that you haven't really tested in the real world. So the best thing to do is to put yourself in a position where you get exposed to different variants, and make a decision as to where you want to spend your time that's educated by now knowing what you really like, rather than guessing before you've actually done it. Yeah. And the way you do that as a career is, and hence perhaps why this is sort of in the bell curve, the center of the distribution, you do something like you work for a major investment bank or for a major consulting firm, because if you work at JP Morgan, you might do a rotation where you do some investment banking and some sales and trading, and you might look at private equity and something else. Now, it's not infinite. You still have to make some decisions, and there's some luck of the draw. but at least you get to try different things
Yeah.
rather than deciding while sitting in your dorm room at Imperial that for sure you want to do, crypto, never having done it. So I think it's important to line yourself in a way where you are, unless you have a very clear perspective that you absolutely want to do a certain thing. Like, the guy that runs Citadel, right, Ken Griffin, he started trading convertible bonds out of his dorm room at Harvard, right? And so by the time he graduated, he was running tens of millions, I think it was. So, you're a little behind schedule if that's what you want to do. But that's just who he was. He was wired like that's who he was. And that's not a common example, right? So, but if you are him, then you shouldn't be doing this podcast. You should be in your dorm room trading right now. If you're not Ken Griffin, then it's like, I don't know, you should probably go and find a place that you get exposure to different things. And maybe in the modern world, switching jobs doesn't have a stigma associated with it. So you try a few different jobs and you try and line it up. Maybe go to business school at some point. And you try to make the most informed decision of where you are aligned in terms of something that you really like, that also meets whatever other goals for success or whatever else is important to you in life.
Great, thank you so much.
Yeah, no problem.
Thank you so much.
Thank
You're
you.
welcome. My pleasure.